Good morning from Los Angeles, where it's 10 a.m. Pacific. Welcome to Power Hour. Um, and good afternoon, wherever you are on the East Coast or Central Standard Time. It's Friday. The week is almost over. A lot to talk about. Before I get into the specifics of the live stream, um, some business to take care of. Thank you for the support. Channel is growing. Please, share the videos with friends, coworkers, relatives. Great information, really. Honestly, um, educational, informational. Not trading advice, not investment advice, but I do talk a lot about my positions. I share my trading account with you all. Uh, Yeah, I'll get my 1K pretty soon, we Zoom. Welcome to Power Hour. I'm going to talk about 3 or 4 different topics today. The usual Q&A at the end. I'll go through some stocks that I'm watching and actually buying as we speak, and some short position that I have created. Next week, actually, I'll start talking about shorting the market, because I think we're at an inflection point. So I also have a website, www.sergioavidian.com. I'm trying to get some subscribers together over there for a free newsletter that I'm going to be sending out starting July. So please go to www.sergioavidian.com. Sign up to the free newsletter. Once you put your email in, you'll get it in your inbox free. I will probably do that at the start, at least once every 10 days. It'll be about finance. It'll be about current topics that I've discussed in the past, and I'm going to continue to discuss going forward. So with that said, welcome everybody. I'm going to get into the topics right away. The first topic that I'm going to talk about is, it's something. I mean, look, I've been talking about the Fed and the Washington, D.C., the inability of these people to to get their house in order. And unfortunately, they're not doing a good job. And why aren't they doing a good job? I don't know, honestly. They have created this mess, and we're living with it. Let me fix these little screenshots that we're looking at. Let's see where things are at today. Okay. I don't know. Which one do you guys like? This one or this one? I think this one is better. No? Yeah. Or let's see. This one? No. This one. Sorry about the play. Well, we'll just leave it here. So the first topic at hand is going to be the deficit, right? Look, there's no ifs and buts about it. We're adding $1 trillion worth of deficit to our budget deficit every 100 days. This is reality. There is massive effects of what this is going to do to us, our future, our kids' future. But to be perfectly honest, I am not happy about it. Right? Why should anybody be happy about this? And if you are happy about it, well, you let me know. I'm certainly not going to continue going along with the charade that we're experiencing. And here it is. The first 8 months of fiscal 2024, okay? The U.S. deficit hit a whopping 1.2 trillion, or to put it mildly, close to $5 billion a day. It's every single day, okay? In May alone, the deficit spending was 348 billion, or 11.2 billion a day. according to the CBO. CBO is the budget office, government budget office. They're the ones that keep track of these numbers. You have to take them at face value. If they say so, I mean, that must be true. Over the last 12 months, the U.S. deficit totaled $1.7 trillion, equaling 6.2% of U.S. GDP. The deficit as a percentage of GDP is above all-time highs, literally like ridiculous levels, okay? And it's actually the only time that was our deficit per GDP was higher was during the pandemic, because we had to spend $7 trillion to get the economy out of the mess that it is in, right? And well, how's this going to resolve itself? I am honestly not sure. The deficit spending as a percent of GDP is above all previous recessionary levels, except for the 2008 financial crisis and the 2020 pandemic and World War II. Look at the situation that we're in. At the same time, government expenditures, okay, what we spend, which we don't have. The way we spend it is we print it and we spend it. Hit $6.5 trillion, which is 23% of US GDP. Okay, our gross domestic product in this country is about $27 trillion. Okay, this is what the economy produces. This is what all of us produce. It could be manual labor, it could be service industry, it could be manufacturing, all of it. It's about $27 trillion per year. Our expenditures, just the government expenditures, are at 23% of GDP, and our debt to GDP is extremely, extremely high, right? So, and here's a little chart that I thought I would put up. As you guys can see, this chart goes to 2019, and in 2020, when the great financial crisis hit, and it spiked. You guys see that spike, right? And during the pandemic, the last spike that happened right about 2020, October 2020 to 2021. And then the deficit came down. Why is the deficit coming down, by the way? The tax receipts of the government is mostly dependent on the stock market staying where it's at or going higher and higher, because that is the majority of the tax receipts we're getting from capital gains, right? The higher the stocks go, the more capital gains people have to pay when they sell their stocks. And that's where our revenue is coming from these days, not from actual tax receipts. And so what is this going to create? Where is this going to end? The total deficit is 35 trillion. Next week, I'll talk about the CBO estimates going back 10 years out. There's talk that deficits are going to hit $60 trillion. Okay. I mean, how's this going to be resolved? I don't think that debt is ever going to get paid back. And now, the a lot of bigwigs now, including Jamie Dimon and Janet Yellen, the Treasury Secretary. I mean, the Federal Reserve Chairman, Jerome Powell has been talking about this for the last, I don't know, year and a half or so now, asking Congress to put their house in order because monetary policy follows fiscal policy, right? They have to create this money somehow to make up the budget, to balance the budget. And that's being done by printing, US dollars. And that is creating inflation in its own. So the federal IOU now, as of this second, those are all IOUs. And in the past, I talked to you guys about countries debasing their dollars, right? They're getting out of dollars, just like China is selling US treasuries. Japan is selling US treasuries. The BRICS, which is the European countries, they're selling their treasuries. They don't want to own the dollars because we just keep devaluing the dollar. The only reason we can keep doing that and the dollar is because the dollar is still the reserve currency of the world. But last week I talked about Saudi Arabia getting rid of the petrodollars. Now they're going to do dealings in other currencies, right? A lot of people are catching up to this game that this is out of control. These people don't have their house in order. Why should I keep my assets in dollar-based, in dollars? It's losing value continuously. And we know that on a small basis, let's say when we go to Costco, right? I mean, everything has gone up. The price of everything has gone up. That's called inflation. So the federal IOU now is $34.5 trillion, or about 11 trillion higher than where it stood in March 2020. According to CNBC, and Jeff Cox, a really good journalist, says chatter has spilled into government and finance heavyweights. Yeah, and I've been talking about this since I started the channel about 6 weeks ago. And has one prominent Wall Street firm wondering if costs associated with the debt pose a risk to the stock market rally. Well, it doesn't seem like it, because the market just keeps chugging along, and we call it on Wall Street climbing the wall of worry, right? And it keeps making higher highs, although it's being kept up by about 4 stocks now. It used to be Magnificent Seven. 3 out of the 7 is kind of petering, and the 3 that just keep taking the train higher and higher. The CBO, Congressional Budget Office, estimates that debt held by the public compared to GDP will rise to an amount greater than any point in the nation's history. I mean, where are we here, people? What are we doing here? And the Fed chair, Jerome Powell, said recently that this is something that elected people need to get their arms around sooner than later. The panic buttons are being pushed. However, this year is an election year, as we know. Do you think the politicians in Washington are going to do anything about it, or do you think they're going to save their asses, save their jobs first before they tackle the deficit issue? Look, I'm not a political person. I don't like the government. Either way, Democrat or Republican. I don't trust the government, but somebody has to tackle this problem at some point. Kicking the can down the road continuously is not going to solve this problem. Putting our head in the sand and not talking about it, let somebody else take care of it, is not going to solve the problem. I mean, this is a massive, massive, massive problem. Okay. And if it's not taken care of, right? I look at this deficit, and by the way, I talked about it last week, right? Just the servicing of this deficit is up to $900 billion, which is more than our Medicare budget, which is more than our defense budget. Why should we pay all that interest? Why can't we lower this deficit, not spend the money we have, just like in our own homes, right? We have budgets. We keep our budgets. We don't print money. We can't anyway. So that $900 billion just in interest that we pay on this $34.5 trillion IOU, because it used to be zero, now it's $900 billion a year, just the interest payments. This debt has to get serviced. Just like when we have a credit card debt, we have to make payments. U.S. government has to make payments on this debt, and it's up to $900 billion. That $900 billion could be used for so many good things if it didn't exist. And for 15 years, when we had ZIRP policy, zero interest rate policy, we didn't pay too much interest on that debt. Well, now that the rates are at 5%, they had to do it because they created inflation. They're trying to kill it now by raising rates from 0 to 5%. Now they have to pay interest on all that debt, right, at a 5% clip, and at $900 billion. Couldn't we take that $900 billion, get our infrastructure in order? Couldn't we take that $900 billion and create some social programs that would help actually people? Couldn't we? I mean, the more I look at this, the more I'm going the Elon Musk way. Okay, at some point, right, we're going to have to provide income for some people. With AI now going where it's going, supposedly replacing everybody's jobs, what are these people going to do with this debt and with the interest payments that we have? All of this combined, I'm not liking what I'm seeing. My crystal ball is not liking what I'm seeing, but that's the topic. A lot of people are pushing the panic button, maybe not the panic button, the warning button, but I don't think anybody's listening. I don't think anybody's at home. And if you guys count on Washington, the House and the Senate to do something about it, good luck. They haven't done anything about it. Both parties, when they are in charge, and there has been periods that the Republicans had the executive branch and the legislative branch, nothing was done. Well, there was some movement towards balanced budget amendment. I remember that, Newt Gingrich days. It kind of worked, actually. But then when the Democrats show up, tax and spend. When Republicans show up, cut taxes and spend. It just doesn't work. And both sides just need to get their shit together and save this country from going into a deeper hole than we're in. But then the CBO doesn't think so. CBO thinks the budget deficit is going to be by in 10 years is going to be close to $60 trillion. Well, I feel bad for my kids. That's how I'm going to end this segment. Next topic we're going to talk about is, last week we had an inflation number that came out, right? And market took off, made new highs. And I talked about it, and the Federal Reserve Chairman says everything is fine. Unemployment is low. GDP is not slowing down because of high interest rates. We're going to keep rates high. We're not going to cut rates maybe once this year. We're going to cut them and twice next year. So they kick the can down the road. It's an election year. I mean, when was the last time Fed raised rates in an election year? Never, right? I'm surprised that they're not going to cut the rates twice this year while the market's making all-time highs. But the consumer is saying something else. The consumer, me, you, all of you watching, and you're going to watch later. The consumer is saying that there is something called that the Federal Reserve brings out, the Federal Reserve Economic Information Office. It doesn't show that the consumer is confident. I mean, here's the charts, the two charts on the right-hand screenshot, as you guys can see. Consumer sentiment has been declining, and it's at a 7-month low now. Now, the consumer sentiment is something that we need to watch. Why? Okay? Because we're not a manufacturing economy any longer. We used to be 30, 40 years ago. We used to produce stuff. Now we're a service economy. And what does that mean? The consumer is 70+%, close to 80% of our GDP, right? In the previous segment, I said our GDP is $27 trillion, right? 80% of almost all that is consumer spending. If the consumer doesn't spend, economy goes into a tailspin, economy goes into a recession. That's where we are. That's where we put ourselves into, that kind of box, right? So consumer sentiment has declined for 3 straight months to its lowest level since November 2023. Well, on one end, the bigwigs are saying everything is fine. Inflation is going to be under control. Unemployment is low. GDP is still good. We don't have to worry about it. While the consumer is who we are, voting with our pockets and saying, man, this is not looking good to me. What if I lose my job? Should I tighten my belts and spend less money? I don't know. So the consumer sentiment index fell from 69.1 in May to 65.6 in June. Okay, well below. And then there's always expectations of 72%, right? And Americans' perception of their personal finances plummeted by 12 points to 79, the weakest since October 2023. Well, what is happening is that when the Fed raised the rates from 0 to 5%, there is always a lag in all of this, right? The effect of that showed up in our mortgages. If you had an adjustable mortgage, your mortgage is going through the roof now, right? Maybe the house is not going to be as affordable as you think it is going to be. Your credit card payments have gone up. If you bought a car or if you had an anything adjustable rate, right? They got all adjusted over the last 6 to 18 months, and now you're suffering, right? Your payments have gone up while your debt has remained the same. And what happens? The confidence goes down. We don't go out to dinners anymore. We don't spend too much money on vacations anymore, right? So consumer sentiment is tanking while the Fed is saying everything is fine. So you guys got to believe one or the other. I'm believing the consumer. The consumer votes with their pocket, and since over close to 80% of our GDP is consumer spending, watch out. People saying, there's going to be a soft landing. Fed is doing a wonderful job. I'm not buying any of it. And consumers' assessment of economic conditions also declined to the lowest level since December 2022. That's because of the lagged effect of these higher interest rates. Higher interest rates are taking a hold in the economy, and the consumers are suffering, right? I mean, I look at the Fed numbers today, actually, before I came on the live stream. The defaults on car loans, the defaults on credit cards, and this has nothing to do with income levels, by the way. At every level, they are at an all-time high. They're going through the roof, right? And this is supposedly with a good economy, right? And meanwhile, buying conditions for durable goods dropped to the lowest in 19 months as prices remain elevated. Yeah, because due to inflation, the manufacturers of all goods raise prices. Will they ever lower those prices? No. If history is a witness to what has happened in the past, is these companies raise prices, they lower it a few percentage points, but they keep it at an elevated level, and it's beneficial for them. That's one of the reasons earnings estimate in the market keeps going higher, because their profit margins are higher. And finally, consumers are feeling the pain of inflation. Absolutely. If any of you say that I'm fine with inflation, now you should be fine with inflation if you own hard assets, right? If you kind of own some real estate, yeah, we know what has happened to those prices. That's the inflation hedge. If you own some gold, if you own some Bitcoin, if you're in the stock market, I mean, look, the S&P 500 at 5,500, right? Who would have thunk? All-time highs every day. If you are in all that, yes, I will answer questions, Robert, at the end of the show, though, in about half hour or so. If you own all the hard assets, yeah, you kind of kept pace with inflation. Otherwise, inflation is chewing about 5 to 7% of your existing dollars that are maybe in the bank, maybe somewhere else, whatever. But if you're holding cash, you're losing value, 5 to 7% of it every single year. And yeah, it's a problem. I mean, and one of the biggest parts of this, that the Fed does not count, by the way, and this is part of the same idea, is that I have been in this country for over 30 plus years, right? And I never remember food prices going the way they have gone over the last. I mean, food is something we have to eat. We have to sustain ourselves. We don't have to go buy new clothes. We don't have to buy a new car. We don't have to buy a new house. Those major expenditures. We don't have to buy a new TV. We don't need a new cell phone, maybe, but we have to eat, right? And I thought I'd talk a little bit about this subject, that food inflation has absolutely gone through the roof. And to me, when the Fed says X food and energy, inflation is doing fine. The Fed, Mr. Powell, who doesn't eat, who doesn't use energy? I'm not sure. I'm not sure why, some of the CPI numbers do not include food and energy. I understand why. They say they're too volatile, right? They're going to kind of mess up our numbers. I'm going like, yeah, but I have to spend money every time I go to the market. I spend more and more money, and my income has not kept pace with that inflation. So how much have food prices increased in the US? Well, let's take a look. There's a chart. Again, these are facts. These are not hearsay. This is not BS. These are facts. We're all experiencing it out there. While overall CPI inflation grew 3.3% over the past year. Do you guys believe that number, by the way? Do you guys believe the 3.3% that the government says that what inflation is? I'm not buying that whatsoever, right? How about we double that, and then maybe we'll have a conversation. While overall CPI inflation grew 3.3% over the past year, most food items prices have risen much more than that. Yeah. Juices and drinks prices have seen 19.5% spike over the last 12 months, right? The most among all food categories. Frankfurters, bacons, we love our hot dogs, we love our bacon, have soared by 7.3 and 6.9%. Sugar, well, we're an overweight country because we love sugar. Sugar and uncooked beef roasts have also experienced significant hikes of 6.4 and 6%. So how's inflation 3.3%? Because the inflation numbers are X, meaning without food and energy, okay? And meanwhile, fast food prices, which all these companies are complaining now, right? They're laying people off. They're saying, oh, we can't keep fast food prices low and have employees that we're paying $20 an hour. How can you live for $20 an hour in California, right? But this is the thing that I don't understand. They lay people off and they blame the politicians for raising the minimum wage to $20 for fast food workers. Well, these people have to live too, right? They have to buy the same food that we're talking about here. So fast food prices are up 31% over the last 4 years. I agree. I mean, hell, you go to I don't know, let's go to your favorites, McDonald's or whatever. You buy a, Big Mac meal is $15 now. I mean, can you guys, hello, right? So inflation is hurting everybody. And, going back with this consumer sentiment that I talked about in this segment, valid. right? Inflation is hurting us. Inflation has not gone anywhere for the average consumer. For the people who own hard assets, inflation is not a problem. Why? If you own real estate, you can raise the rent, right? And somebody will pay for it, obviously. If you own gold, you're doing fine. If you do own Bitcoin, so far you're doing fine, kind of looking toppy there. But my point is, the average American doesn't own assets. 1% of the population owns 90% of the assets in this country. And that wealth transfer has been happening over the last 20, 25 years, 30 years. And again, I'm not a socialist. I'm a capitalist. I love what I do. Wall Street is, finance, all that good stuff. But all of us have to kind of see these, writings on the wall and act accordingly. And inflation is hurting everybody. And on the next topic, I'm going to talk about, something that I haven't really talked about yet. But again, this is none of this, by the way, doom and gloom. These are things that I'm seeing, and I'm just trying to connect the dots, read the tea leaves of where the market is going to be, because that I trade, right? So that's me. Maybe none of you do, but then for me, it's important to see this big picture, read the tea leaves correctly, and then, place my bets, for lack of a better word, in correct places. Okay. So you have to look at the microeconomy, you have to look at the macro, you have to look at the fundamentals, and then you have to look at the technicals, right? And once you put all this together, the big picture makes sense, and then you make an investment or not. One of the things that I hadn't talked about yet is, which kind of is happening, but then there's also why it hasn't taken place yet, is the housing market, right, in 2024. Now, I talked about adjustable mortgages. My mortgage personally is at 3.75% for 30 years, right? I was lucky enough to refinance and lock it in. Could I buy a house today, even with my financial status? Absolutely not. In California, especially, because when the rates went from 0 to 5%, mortgages went from 3.75% to 7.5%. On jumbo loans, probably higher. So even this is with good credit, by the way, right? With a good credit score. And a lot of people have been expecting, right, housing market crash, right? Well, I'm going to kind of connect this with the affordability side of the issue. When the rates go up on mortgages from 3.5, 4 to 7.5, 8% on a 30-year fixed, which is the most popular, mortgage these days, your payments on that mortgage is going to double automatically for the same price of the house. If you're buying $1 million house, which in California these days buys you a shack, right? Let's say you have the $200,000 to put down 20%. You take the mortgage out at 80%. That same mortgage at 3.75 or 4% versus 8% is a double. Are you making double the money that you were making last year to sustain that servicing of that debt? No, nobody's going to give you the loan, right? And so the demand for housing is not there. However, what else is happening is that there isn't too many houses going on the market from people like me. My house has doubled over the last 20 years. Okay. But now I'm thinking, okay, I can sell the house and take that equity. But if I have to go buy something else, I cannot downgrade yet. I have kids at home that are in college. Once we're empty nesters, maybe I'll downgrade, go to a townhome or something with the wife. But at the moment, I have to go in another house. If I go in another house, well, I'm going to sell my house at double the value that it was 20 years ago. But then now I have to go buy something that's double the value itself, plus the mortgage. I cannot sustain that kind of mortgage. I cannot make payments on that kind of mortgage. So that's why I don't think it has added to the pain. Meaning, a lot of people with 3-4% 30-year fixed mortgages are not selling. They're not sellers. Although they have massive equity gains, they've accumulated a lot of equity in their homes. They're not selling. So because of that, the market is kind of balancing itself out, right? But if you're a new buyer today, okay, if you're just starting life, if you're in your 30s, let's say you graduated college, you're married, you have no kids yet, but you're planning on, having a family with kids, you're out in the market for a house, right? The affordability index is absolutely in the tank. And home buyer conditions for U.S. consumers have declined. We talked about consumer sentiment going down, right? And home buyer conditions for U.S. consumers have declined to an all-time low in June 2024. Look at the chart on the right-hand side. Look at the big circle on the right-hand side. This chart goes back to 1990s, I think it's, let's see, 1980s, 1990s. Yeah, 1990 to 94. We are exactly where we were back then. Why is that? Well, because of inflation, housing prices have gone up, mortgages, interest rates have gone up. How does let's say you're 30 years old, you graduated college, you got a great job, you're married, your wife has a great job, two incomes. Let's say you save the money. How can, when with this affordability situation, how can you get into a new house? So the demand on housing is not there, right? Because of affordability, not because of anything else, not because we're not building any more new homes. And the existing homeowners are not selling because wherever they go, they cannot afford the higher interest rates or higher mortgages that they're going to have to face. So that's why I think the housing market is just kind of holding its own, because there's not a flood of sellers in the market trying to grab that equity like myself, because I'm thinking, well, if I sell it, I go somewhere else, I can't afford the new house. So I'm going to stay put. Okay. But for people, for younger people who are starting life, it's not there. The affordability is not there. That's with the assumption of them having a 20% down payment, right? So the index of buying conditions is now at 27 points below the previous all-time low recorded in the 1980s. Think about what we're doing. And this is all connected to the deficit problem that created the inflation, raised the rates. All this is connected, okay? And this was when 30-year mortgage rates were between 12 and 19%. These are true numbers. I remember those days in 1979 when Paul Volcker was trying to kill inflation, and he raised the short-term rates to 20%. People, we had 20% interest rates in the US. 5 is not high, so don't complain about 5. 5 is actually lower than average. And in those days, right, the 30-year mortgage was between 12 and 19%, but then the housing prices were not that high, right? And now the mortgages are about 7.5%. Since 2020, the index of affordability index has dropped by a massive 80%. Think about it. Now, when we had zero interest rate policy, everybody was flipping homes, speculators were flipping homes, people were buying homes because mortgages were 3.5%, incomes were keeping pace, no problem. But then what happened? Not only the prices of homes went up because of inflation, okay, the interest rates went up now to kill the inflation that they created by printing money. So double whammy. You guys see what's happening here now? And is this going to create a housing crash? I don't think it is, just for the fact that people like me cannot sell and go anywhere. I'm not going to sell. I cannot sell and take my, I don't know, $700,000 equity that I've, accumulated over the last 20 years, because I can't go anywhere. I can't afford the house that I need to get into the next one. So I'm staying put. That's why there's not enough sellers in the market. So it's kind of balancing things out. And meanwhile, the U.S. median home sale price reached a new record of 400,000. This is the U.S., all over the U.S. We're at $400,000. Okay, and housing, and so there something has to give. Okay, either that 393 U.S. median is very high, or right, that has to come down. The only way affordability is going to move from that chart that you guys see on the lower right-hand corner with the big oval around it is two things. One, interest rates go back down. But if interest rates go back down, inflation is going to reaccelerate, and that housing price at 393 is going to go to 420 next year, right? So, or what has to happen is there has to be a recession. Housing prices have to correct by 20, 30%. Then the Fed will cut the rates. Then the mortgages will be back down to 4 or 5%. Then the affordability index will kind of balance itself out. Otherwise, good luck. If you're starting life, trying to create a family and put a family together and get married, Unfortunately, for the newer generation, affordability is not there. So I'm gonna hit on a couple of other topics. I mean, my favorite, obviously, and everybody's favorite has been NVIDIA for the last, I don't know how long. Actually, before this last 2-day correction, which I kind of participated, I made money on my small Robinhood account. Is NVIDIA has been the talk of the, I don't know, last 2 years, 3 years, but specifically last year, right? Before this last 10, 12, 15 point correction from 140 down to about 125, NVIDIA was or had become the most valuable company on the planet. We're talking, we're including Microsoft, we're including Apple, we're including all that. At 140, company was worth $3.5 trillion. Trillion with a T. Okay. Now, here are some points, and I'm going to give you my, when I go through the charts, I'll give you guys my opinion of what I think is going to happen. So NVIDIA is now larger than, listen to this, people. This is that's why I like these people on Twitter. By the way, I am on Twitter. Please go join me on Twitter. I'm active. The Kobeissi letter. They put out these short little tweets that I love, right? And I mean, instead of me doing the research, they're doing the research. I just talk about it. NVIDIA is now larger than, okay, one, GDP of every country in the world, one single company, except 7. And we can guess which ones they are. China, Japan, right? US, obviously. Think about this. One single US company is worth at $3.5 trillion market cap, is larger than the GDP of every country in the world except 7. The entire crypto market combined, that includes, so 1.5 trillion of Bitcoin, right? Put all the coins, Bitcoin, altcoin, shit coins, all of that, Ethereum, Litecoin, Solana, all that is larger, one company in the entire crypto market combined. NVIDIA is worth 5x at today's price the market cap of Tesla. Now, not that Tesla should be that high, but that's, again, my opinion. The next one, think about this one. NVIDIA at the current price is 6 times the market cap of Walmart. Think about it. Walmart has like 5,000 stores, 500,000 employees. They're doing something. And I'm like, not that NVIDIA is not doing anything, but I'm just trying to kind of make you guys understand, put it in some sort of perspective where the bubbles, how the bubbles get created, right? NVIDIA is larger at 3.5 trillion than all of Canada. Canada produces a lot of metals, a lot of oil, right? Gas. Canada's GDP, total GDP, plus $1.2 trillion in cash. I was like, I go, this is great. I have to talk about this. NVIDIA, which is another chip maker, which I started actually turning positive on, which is AMD, which is in my weekly watch list, 13 times larger than AMD. They both do the chips. Obviously, NVIDIA does kind of different chips, GPUs and things like that, which is going to be supposedly using AIs and all these other servers that super microcomputer is creating. So there's so much money that's gone into NVIDIA, right? Why? Because of the promise of AI. AI. I'm like, okay, good. When I see this, I've seen this movie a few times in my life, in my trading career. These things don't end that well, but who am I to talk about? But I'm going to give you guys my opinion of how NVIDIA should be traded. NVIDIA is 3 times the GDP of the city of Los Angeles, okay? NVIDIA is larger than Amazon and Berkshire Hathaway combined. I'm talking market cap now, $3.5 trillion. Are you guys getting this picture now? And NVIDIA is at 3.5 trillion, worth more than the collective net worth of 12 richest people in the world. And we know, Ambani, that includes the Indian guy who's at, like, I think he's the richest guy at the world, the Mexican guy. I forget their names. Ambani, I think, is the Indian dude who's in its conglomerate worth like 300 trillion. Or no, I think the Louis Vuitton guy, LVMH, I think in France is that they're all like worth 300 billion, 200, 300 billion. So it's worth more than the 12 richest peoples. NVIDIA's market cap is now worth more than the entire US oil and gas industry. Okay. NVIDIA is also worth more than every single building in New York City combined. This is great. And since October 2023, this is not no long ago. This is like October 2023 is like, I don't know, 8 months ago. Since October 2023, NVIDIA has added 2.3 trillion in market cap. Is this the best run in stock market history? Is there a question about that? I think I am. This is amazing. Now, it goes to show that if you are an investor, not a jockey, okay? By the way, if you invested in NVIDIA when it came public in 1999, and that's not long ago, that's only 25 years ago, that $10,000, okay, would be worth close to $5 million today. Think about it, okay? But that's not the issue. So the stock had this split, right? And I talked about it, that after splits, stocks kind of sell off. There's going to be a massive rebalancing coming up tomorrow, actually. All the major funds have to buy shit ton of NVIDIA. So, but it's already probably balanced. That's a technical problem. But what I'm saying is that investing is wonderful, right? If you didn't even have to know about, AI. Nothing to do with fundamentals. You just follow the chart, follow the trend, okay? And we talked about NVIDIA endlessly, and so does everybody else. I mean, these are some tulip numbers to me. the tulip craze in Netherlands in the 1700s. But then I will break it down and give you guys my opinion how it should be traded, if at all traded. If you're not a trader, if you're a buyer and holder, there's nothing wrong with NVIDIA. And then the second favorite of the crowd on the internet is these days GameStop, right? I have to talk about it because there are some silly headlines flying around on some reputable, online outlets like MarketWatch. Is GameStop the next Berkshire Hathaway? Joseph Adinolfi. I don't know. You should write articles at all. Is GameStop the next Berkshire Hathaway? Okay, so I did an NVIDIA video. It probably got like the second most views in the last 6 weeks that I've done, and I got so much hate. I had more thumbs down on that video because I call these people the meme boys, bag holders. I mean, they are. And I'm going to give you guys my opinion. Who is the winner in all of this? In all of this meme boys, Reddit groups, Roaring Kitty, Keith Gill, all the jockeys, right? All the diamond hands. I see one winner in here. One and only winner in here. Okay? Is the company. The company was left for dead in 2020. Stock was $2 a share. $2 Okay? They had no future. Brick and mortar retailer going out of business because all the online gamers came around and absolutely were smashing this company. The company didn't pivot, continued with the same thing. Well, the first short squeeze happened. We know what happened in 2020. The first craziness took place. Something different happened. But what happened is that every time GameStop went up, the company issued shares. So from having a long-term debt problem and literally losing money every quarter, bleeding cash problem, the company, with the help of the new retail investors, with the diamond hands, with the people who totally believe Keith Gill, Roaring Kitty, his plan, And we know what happened to the stock. I mean, stock went from $2 to $400 in 2020 in that craze. And then it took kind of, to a smaller degree, it took place again over the last month and a half or two, right? I mean, if you don't know anything about GameStop, then I don't know. You must be hiding under a rock. So long story short, just over the last month, because of the second craze that took place, the meme stock attack and Keith Gill and Roaring Kitty buying options and shares, stock took off again. All right. When it took off, what did the company do? About a month ago, they issued 35 million shares, because companies can do that. They take advantage of a high stock price and then issue shares and collect cash. Somebody bought it, 35 million shares. On the last leg up to the 60 level, company sold another 75 million shares. So this company, with the help of the little guy, retail investor, who most likely got hurt in all of this overall. Yes, Roaring Kitty made 53, he ran his 53,000. Now he owns 9 million shares of GameStop at $25. That's 200 million. He ran his 53,000 into $200 million. But every time the stock went up, company issued shares. Company has 425 million shares outstanding now. However, from being a dead as a doornail company, now, that's why I think the article came in comparing it to Berkshire Hathaway, because Berkshire Hathaway is sitting on $187 billion in cash, right? The company, from not only they paid their long-term debts down, now the company has zero debt and about $4.5 billion in cash. Now think about this. What could be done with that $4.5 billion in cash, right? So the retail, the little guy, the diamond hands people, the people who bought the shares and are holding on for dear life. Now, my opinion, stock is about 25. There are 425 million shares outstanding. The odd thing is, there are still people shorting the stock, betting that it's going to go to nowhere, right? Here's the deal, though. Not too many institutions own the stock. Mr. Cohen, who's the CEO of the company, owns about 10% of the shares. The people, the little people, we own about 70% of the shares. And a lot of people say, I swear to God, I'm never going to sell it until it goes to $1,000, which I don't think it will. But institutions own very little percentage of the company, because people who ever bought the shares are just holding on to it, and they're not allowing it to be lent out to short. Well, there are still shorts. There are still massive, well, not as massive as in 2020, but there are still, in 2020, by the way, it was over, the stock was shorted by 110%. Think about it. There's 100% shares out there, 110% was shorted. Now, if you look at the short interest, as of the 15th of this month, actually, we're sitting at about 70 million shares short, which is still quite a bit. And out of 425 million shares, you're looking at about 15-18% of the outstanding shares are shorted. Is it going to be another short attack, and is it going to be going double, triple? Probably not. But here's the fundamental part. What should they do with that $4.5 billion in cash? $4.5 billion in cash, by the way, on 420 million shares outstanding, is $10 in cash. Stock is 25. Now, out of the $25, $10 in cash, no debt. Look where the company is at with the help of the little guy, okay? And who's the winner? The company is the winner, ultimately. So $10 is in cash, $15 is enterprise value, all right? Is the company worth $15 extra above its cash value? I don't think it is, because there is still an antiquated business with brick and mortar, selling video games and Nintendos and PlayStations and whatever. That's a dead business, right? The brick and mortar business is dead. But now they have a war chest of $4.5 billion. What should they do with that? Should they go the Michael Saylor way, who was the second genius that I like on this planet beyond Elon Musk? Should they go buy Bitcoin? Just like, actually, Michael Saylor just borrowed another $700 million, bought another 12,000 Bitcoin a couple days ago. That guy is just borrowing money and buying Bitcoin. That company is either going to go to the moon when Bitcoin, if in Bitcoin goes somewhere, or it's going to zero, because he has so far borrowed $3 billion on convertible bonds and bought Bitcoin with it. What should GameStop do? Should GameStop buy another company, maybe an online company, maybe get into a different business? Now they have the firepower. They have $4.5 billion in cash sitting on it. Or should they go do what Michael Saylor is doing with Bitcoin? I think part of it probably should. I'm not going to give advice to GME board of directors. Or should they park it in Treasury bills at 5%? If you put the $4 billion in cash in 5%, $200 million a year. Well, they are losing $35 million a quarter. Or should they shut it down and return the cash to the shareholders? Should they go buy another company in the online gaming business? I mean, look what the retail trader has created for this company. A dead as a doornail company has become $4.5 billion cash-rich company, which is a great problem to have these days, by the way, right? And they have operating losses, right? So what should they do? What do you guys think GameStop should do with that $4.5 billion? I think it's going to be very interesting to watch. Is it against short squeeze candidate that's going to go to the moon? I doubt it. Would I buy the stock in itself at $25? No, because I don't think the enterprise value is there. Is it going to go to the cash value to $10 a share? Probably not, because it's just too hyped. It's not going to happen. But I think I honestly think if the management listens to anybody, are they a Berkshire Hathaway? Of course not. But they have a cash hoard that they can actually do something with. $4.5 billion is a serious amount of cash, and it only happened because of the small investors believing into this company and bringing it back from absolute dead. So something I'll keep following. It's interesting to me. Is it worth 25? Probably not. Is it going to go to 10? Probably not. Would I be a buyer? I'll probably buy like maybe $5-6 above cash value. Give it a little bit of enterprise value. Not that these stores are not selling; they're still selling. They had revenue of like $900 million last quarter, but they're losing money. The margins are not there. So, kudos to the retail investor. One for the good guys. They saved the company. Now they have $4.5 billion to play with, and good luck to them. So, and last one before I answer questions and go to my charts is my little Robinhood account. I started with 1,000. The first week it went to 11.19. As of last week, it was 26.40, and as of today, about 9 a.m., 28.40. I made a couple $100 this week. I'm slowly, growing the account. I'm happy with it. I mean, it's like 6 weeks, I think. Up, I don't know, close to 200%. I mean, I still can't do a lot of things in it. Once I go to maybe 5K, I can be a lot freer and, do different things with it. But I'm happy with it. If you guys are following me, it's good. Now you're all going to say, well, we don't know why you're buying and selling. That's coming up. So with that reminder, go to the website, www.sergioavedian.com. Sign up to the newsletter because I have some plans coming up on that. And with that said, let me answer some questions if there is any. By the way, share the live stream, share the videos, have the channel get to 1,000 subs. Hello. Forget my kid's future. I'm worried about my future. Yeah, I don't blame you, Zoom. Who you're voting for president? I'm not going to say. Maybe time comes closer. I will. Good morning. This is an ant-free zone. They're removing high inflationary items from the inflation reports to make inflation absolutely correct, Mr. Mikhailian. And do you answer questions? Yes, Robert. What is the question? Now I'm answering questions, Robert. Are you still here? If you're here, please send the question in. People who got paid paychecks every month will never understand the common man. Yes, that's true. Although those paychecks adjusted to inflation are not as much as they used to be. Uh, yeah, I agree with Mr. Gambit here. Fairy dust, yeah, but we're going to talk about NVIDIA. It sounds like I'm having an orgasm. No, not really. I'm just talking about it. Got to give them credit for taking. Yeah, well, no, they're not running anywhere. Can you buy other companies? Of course, you can buy other companies, William. There's many other chip companies that you can buy. You don't have to buy NVIDIA. There's a lot of different AI companies out there. Just got to do a little research. About 2 years ago plus, let's see. Vic G says, about 2 years ago plus or minus, when I was driving Uber, one passenger told me to buy AMC when it was over. Yeah, that did not end that well, did it now, Vic? That's why I called them bag holders and the people attacked me. How's driving Uber with Big G? Okay, that's a different topic. These are people messing with the retailer. Okay. Robert, listen to Sergio. He knows what he's talking about. Yeah, I think I do. Yeah. As a fellow Uber driver, okay, let's see. I'm looking to generate passive income per month. What ideas do you have to do so? Absolutely. Yeah. Well, depends on your budget, obviously, right? But if you're going to go after passive income, well, there's passive investing, there's active investing, right? Would I suggest that, first of all, if you can put away money every month into some sort of account, brokerage account, retirement account, preferably a Roth IRA, whatever it is, and put money in there up to your capabilities without touching it every month, and dollar cost average in the stock market itself, which is the benchmark of S&P 500, you should do fine. I mean, depending on your time horizon as well. I don't know how old you are. I mean, I see a picture there, but I don't know if that's you or not. Look, there's never, time not to invest, right? That's the passive part. The other one part of it is passive income you could create by doing many different things, right? If you can get into some multi-housing units and rent them out, that's passive income. If you can get into some online business, create, some sort of online business, maybe an eBay, buy and sell some stuff online, that's passive income while you're still driving. Other passive income, create yourself some, there are mutual funds out there that you can get into and create yourself some high dividend paying stocks, right? You can get up to 6-7%. And rule of 72, people, power of compounding. If you divide 72 by, let's say, 6% every 12 years, your money is going to double. You have to be patient with that game. Passive income could be created many different ways. These are some, and I'm sure people are not short of it. You asked us to remind you about RSI. Yes, RSI. Well, exactly. We're going to talk about RSI when it comes to NVIDIA, when it comes to the market in a second. How many places you can turn 1K to 3K? Not many places, that's true, yeah. But my goal is like by the end of the year, hopefully, maybe 5K. That'll be cool, right? I mean, that'll buy a that'll buy a vacation for me. So let me share my screen with you guys. Relative strength indicator, yes, RSI. Sorry, thanks, WeZoom. Let me add my screen and let's talk about it. All right, here we go. Here we go. Now, I'm going to start with the markets as usual. Okay. So this is the triple Qs. Triple Qs is the NASDAQ 100. I'll answer the rest of the questions later. So we talk about RSI, right? Okay. On the triple Qs, the RSI 3 days ago, sorry, right here on this bar that I'm highlighting was fifth highest ever. Think about ever is a long time, at 81.52. Okay, relative strength index. Okay, the next day it went just a tad higher at 81.59. Okay, that was the high. Yesterday, market had a drawdown. Market was down a little bit, as you guys can see in this bar. Now, we're all looking at the upper right-hand corner of the chart, people. And today, market's down a little bit more. Now, the RSI went from 81.59. As of this second, we are at 71.7. Okay? We're going to talk about RSI. We're going to talk about divergences a little bit looking at this chart, right? So what do you guys see here? What I think is going to happen? See, we had this kind of a pullback before on the RSI. You guys can see where my cursor is at right here. Pullback, and then it makes a new high. I think what's going to happen is that market's still going to, first of all, it's in an uptrend. Unquestionable. Is there a question about it? No. Have we had these little 1, 2, 3% pullbacks? You know, look at this, right? Higher highs, higher lows. Still in an uptrend. I have my uptrend lines up, waiting. There's one uptrend. There's a longer term uptrend I'm highlighting. Here's the 20-day EMA, the white line right here. I highlighted it. Here's the 50-day EMA meaning exponential moving average. And here's the 200-day EMA. Those are all support levels. And the market's so far from those numbers, I'm not even concerned that this is a pullback of any major, that's going to create a major issue. But what's going to happen for my money, and especially on NVIDIA as well, is that market's going to keep grinding, making new highs, but RSI will never get back to 81.59 that it did. And it's going to create something called a bearish divergence. When bearish divergences happen, the stock price or the asset price or the index price will make higher highs, but RSI will never make new highs again. Okay. So then the crack will happen. That's when you see the internals of the market deteriorate, which it is now, advanced decline line, such things like that. And it will just roll over, and then we'll have a massive drawdown of maybe 5, 8, 10%. These 1, 2, 3% corrections that the market's having is nothing to me. It's really nothing. So one of the stocks that I talked about is on my watch list is AMD. Had a massive up day yesterday. It's still going sideways. Not much really to talk about, but on a breakout, the stock is going to go up 30 points higher or 30 points lower. Patience, please, people. 3 Ps. And here's NVIDIA. Okay? Here is NVIDIA. Now, I have my support lines drawn on NVIDIA. Here's one support line. Here's another support line. And I talked about this last week, saying that this stock is so far above its 200 EMA that the kind of correction is imminent. Here's another support line. I have my 4 support lines drawn. Stock is still above its 20 EMA, way above its 50 EMA, and ridiculously far away from its 200 EMA, with an uptrend that comes into play right about 90. This is after a 10-for-1 split. However, again, the RSI, right? RSI reached, when the stock was at 140, all pre-split 1400, RSI reached a high of 81.37. Now, you guys have to understand, when RSI reaches 80s, stock means it's overbought. A correction is kind of imminent. Doesn't have to be a massive correction, but some sort of pullback is imminent. And if you guys can see right here, I'm circling on the chart. When RSI gets up to these levels, like here, numbers are 82.54. The highest I've seen on NVIDIA was 85.26, right? But then on the correction, like it did here, right, from about 74 down to 66, which is 8 points, which is about 12% ish, or 10%, 11%. RSI got corrected down to from 80s to 50s. The key for me to watch RSI is, as long as the RSI can pull back in an uptrend, as long as it holds about 50, I'm okay with it. 50 is the support level on an RSI, and if it does approach 50 with RSI and with your support levels that you've pre-drawn already, you should be fine. However, watch this candle. Well, people call it candles. I don't watch candles. I watch bar charts. This right here, yesterday, stock at 140, and then it closed down at 130. That's called an outside key reversal day. Those do not take place that often. There is one right here, as you guys can see where I'm circling, right? And what happened after that to NVIDIA? NVIDIA graded sideways, retested the high, and then had a decent correction. You went from about 97 all the way down to 75. That's about 22 points. That's about close to a 20%, 25% correction, right? So I'm betting that the same thing is going to happen now. Now that the RSI has pulled back to, as of this second, stock is down another 4 points today, by the way. Right now, RSI is about 63. What I think is going to happen, it's in the first support level. It may pull back to the, serious support, which is at the 20-day EMA right here, which is this line right here. And it will retest the high. My money says so, the way I've seen these things happen before. So key reversal day yesterday and followed by another down day is an indicator that the stock is tired. Is it still in an uptrend? Absolutely. Will I be a buyer and a trader of this right here at the 20-day average, or hopefully at 50-day average? Absolutely. My support lines are drawn. Okay. I'm just going to trade what I'm given. But I think what's going to happen is there will be another rally retesting the 140, 138, 140 high. RSI will not make that old high in the 82, 85 level. And then you will have the correction. Now, even if the stock pulls back to the 50-day EMA, which I just highlighted for you guys, which is as of now is at 107. Stock is 126. Stock at 140. The stock will pull back another $25 and still be in a beautiful uptrend, will create a buying opportunity. So nothing panicking here, normal correction. Honestly, what else is there to say? And I'm going to touch on Tesla. Again, still going sideways, but is squeezing itself into a little wedge, long-term wedge up here. And this wedge is like really important. I think this is going to be the future of Tesla. This uptrend right here that I've highlighted goes back to February of 2020. This down part, the downtrend, goes back to the old high, which is at 400. These are all pre-split, split numbers. You guys see this? This is called a wedge. And how the stock is like every time it hits the bottom of the wedge, it bounces, it hits the top of the wedge, it gets rejected. How many times? Well, this wedge with the price every day is going to get tighter and tighter. And it'll probably have another 2-3 months of sideways, but that's not the point. The point is at some point, this pattern is going to be broken. My history of 30 years says if this pattern is broken to the upside, watch out. It'll be a mother of all rallies, okay? Or if this pattern is broken to the downside, watch out. We're going back to $30. Again, you guys may call me crazy. I'm saying there is massive upside and downside potential coming up on this. But again, patience. There is many other stocks to look at and trade. I will include my watch list, by the way, when I'm done with it. Couple other things that I like. I actually just bought Chewy, CHWY. Here's the chart. You guys know what I do, right? You guys know I wait, and here's Chewy. Is there anything not to like about Chewy at the moment? Right? Okay. What did the stock do? Earnings came out, stock blew out. Huge, massive up day. Then it kind of consolidated, went sideways. Another massive leg up above its 200-day average, above its 20 EMA, above its 50 EMA. All the averages are curling up. Last couple days, stock had a little correction from 27 to 24.5. I'm all over it. I'm buying it here. Every half a point to a point, I'm going to keep adding. With a stop at 22. Here's my stop at 22. Low risk trade. I think stock is going into the high 30s. This is one of the ones I'm buying. Another one, actually, I just started buying today. Lucky you guys. Again, very low risk trade. It's Bloom Energy. This was one on my watch list. I'm buying it right here on the 200-day moving average, about 13, 13, 13, 14. Stock was as high as 18. It had a massive breakout. It's pulling back to support. My risk is about 12 right here, or about 11 and change. So I'm risking about 11, 12% to have it revisit 18 again. So those are the two that I'm actively involved buying. Another one I'm waiting to buy on the next leg up. Two, actually. Well, one of them is one of the ones that I've talked about it before, Carvana. Okay. What is happening with the stock, right? I mean, it's just had earnings, went up, gapped up, came down, closed the gap almost. Now it's just kind of going sideways. On the next leg up, the stock is going to 160s. Just like this pattern right here, I'm circling for you guys. Do you guys see the similarity in the pattern? All it does is go sideways for about a month, month and a half. Patience again. I'll be all over this when it starts moving. You guys need to pay attention to all these. Another one that well, I'm long this one. I told you guys last week where I bought the stock. This is Billy, right? It's the same similar pattern. You know, I keep these are the best setups that you guys can do. This looks like just the Bloom Energy chart, right? Stock had gone to 17, pulled back to the 200-day, rallied, pulled back again, retested again. Now it's making new highs at 18. I've been long the stock since 14. I'm going to keep holding on to it. Nothing wrong with this chart. Let's see, a couple other ones. MicroStrategy, right? They keep issuing stock. I mean, Bitcoin is about 64,000, 63,500. Man, this guy has balls. He keeps borrowing money and buying Bitcoin. Oh, I talked about First Solar. Kind of goofy now. It had a little fake breakout of that flag pattern, and then now it's kind of pulling back. I'll be kind of cautious. I'm not long. Oh, another one, Pinduoduo, which is the parent company of Temu, whatever you guys you want to call it. I mean, it's on the 50-day average. Am I a huge fan? No, but just kind of going sideways. Well, GameStop. You guys want to watch GameStop? There's GameStop right there. I don't know. See those spikes, by the way? This massive spike and this massive spike. That's when the company issued shares. 120 million worth of shares issued, and all the retail bought it. So, you know, waiting game on GameStop. I like this chart, super microcomputer. It had a, I've been watching this, as you guys know. It had a breakout, pullback. You know, I like these types of patterns when stocks start going sideways. But then I told you guys what I'm actively buying. So, you know, which was this one, BE, Chewy. And on the small side, you know what? I'll throw that in there. Serve Robotics. Those are the little bug-eyed robots that you guys see all over the LA. And I even made a video about that. I bought the stock at $2 today. I bought 8,000 shares at 2. Oh, it's at 212. I'll keep adding to it. You guys can get into this reasonably comfortably. I mean, it's, you know, it's reasonably low risk at the moment. If you guys don't believe me, I'll show you my position. I have 8,000 shares of the damn thing. On the daily chart, this is what it looks like. This came public at 4, by the way. Every time it gets down to like 2 and under, it rallies back to 375 to 4. So I gave it a shot. I bought 8,000 shares, average about 210, I think, or overall average. It's at 212. You guys, you know, give it a shot. Low risk trade, really. Like, stop yourself out at 185. I don't know, risking like, you know, 30 cents to make $1.50. Pretty good upside downside. With that said, I'm going to go back and try to answer some more questions. And if you guys don't believe me, here's Serve Robotics, and here's my 8,000 shares. Okay, so I do show the positions. I ain't lying. What else? What else you guys want to talk about? I think that's about it. Yeah, watching Tesla, like AMD, NVIDIA, of course, like on a pullback, more of a pullback actually. I mean, this is NVIDIA going back to people 5 years. Look at this thing, man. Look at this thing. Look at this thing, parabolic, going nuts. Still in an uptrend. Nothing not to like about it. Perfect trading stock now, actually, for me. Because now I have a handle. Now that the top is in at 140, now I have a handle on this thing. Okay. I will definitely trade this now for 5, 6, 7 points at a time. First pullback 120, I'm all over it, which is the 20 EMA, and which also coincides with my support of 117, 117 to 120 range. This has become a perfect trading stock now. Now that the top is in, I can trade it, because once things keep going up, melting up, I can't do it. I have a mental block. I can't keep buying things that are going up every day. But give me a sideways market, I will make a shit ton of money on this now. What else? That's about it. Let's go back to, so I'm buying BE, I'm buying Chewy, and currently, actually, I bought those two today, so you guys know. I told you I got stopped out of Baba with about 4-point loss. But anyway, so let's see if you guys have some questions. I'm going to all in on Tesla. All right. Yes. Stock is striking resistance support means. Okay. Well, look at you. Look at you, WeZoom. I mean, you know your shit. Okay. So let's answer some questions. What is the difference between support? Oh yeah. Okay. Rich, please. I have videos on the channel. I have 100 videos on the channel in 6 weeks. I have talked about that specifically, support, resistance. Please go check those videos out, or do a search. It'll pop up. I've talked endlessly about these things. Basically, the first 4 weeks, I talked about stuff that you guys should know, right? And it was the education part of the channel. Now it's like more like general news and specifics. I recommended 2 books, technical trading books. They're also on the channel, on the videos. They're not expensive. You're going to spend 30, 40 bucks, but you're going to learn a lot, okay? Once you learn, then when I say something, then you will understand that I'm not going over your head. Yeah, exactly. We Zoom. Yeah, we Zoom. We should do the, you know what? We should do the next show together. All right, here we go. Good question. If thinking of buying NVDA at the 20 EMA, the 50 EMA, the first support level and second support level, how do you know which one? You give it a shot. What price action do you want to see to tell you to buy at what level? Well, let's go back to the chart. Let's go back to NVIDIA. Okay, so I had before the top, I had my line of support drawn. Today, it hit one line of support and it bounced right from there. Okay, that line of support today was at 125.96. Stock is 126.77, right? The next line of support is going to be at 116.96, right? But now, in between those two support lines, you have yourself the 20-day EMA, okay? Strong stocks, strong, like NVIDIA, have a tendency. First bounce off a 20 EMA, it's a decent trade, such as this one right here. I'm circling right here. Stock was on a massive uptrend, right? It broke out. It went from 50 to 75. First pullback to 20 EMA is usually a good buying point. And it will never get close to the 50 EMA. That shows the relative strength of the stock, and it will not even blink at the 200 EMA, right? The further you are from the 50 EMA, 200 EMA, that shows the relative strength of the stock. The first pullback, usually to the 20 EMA after a run like this, is a decent buy, okay? The other thing you have to watch is, obviously, you have to watch volume, right? Is the pullback happening on low volume, or is it happening on massive volume, or is there a catalyst? Obviously, you have to watch for these things. But technically speaking only, okay, on very strong stocks like NVIDIA, first pullback to 20 EMA is a comfortable buy. And the way you buy it is you scale in, you scale out, right? Depending on what your goal is. I mean, if you're going to trade options, you obviously look at things differently. If you're going to trade the equity, you look at things differently. But, and then obviously you have to have the risk parameters in, right? So if you buy the stock at, let's assume the stock goes to the 20-day average EMA, and which is today is at, 20 EMA today is at 120 even, 120.14, okay? Stock is 126. Let's say it pulls back another 6 at the 20 EMA, 140 to 120 is 20-point pullback, which is about 15% or 14%. Okay. You bought it at 120. What's your risk level? Do you already have it? Yeah, of course I do. Where's my risk level? Is right here. Here's the next line of support, which is 117. So I'm risking 3 points for the stock to retest at least the high, or maybe 130. So 120 purchase, 130 exit, 117 stop. Right? There you go. That's like 4% downside risk, because that's if it breaks that line, that means it's going to take out, if it closes below the 20 EMA, and if it takes out this next line of support, which is at 117, you have no business being in the stock. You bought it wrong. You take your 4 point loss. But the upside downside is you're looking at a 3-4 point loss versus a 10-point upside. So 3-to-1 risk reward, 3-to-1, right? Always 3-to-1, right? So it breaks that support. What's the next line of support? Well, it's the 50 EMA right here, right? 50 EMA. First time it's going to pull back, it's 50 EMA. God knows in how long. That's at 107.10. And that happens to coincide with the next line of support. Comfortably, you can buy that stock at 107. Okay. Let's say it didn't work out, that it broke that too. Let's say it's hot knife through butter. It's just going down. You have your risk set up. Risk set up is right here, right? You bought it at 107. Here's the next line of support right here, which is about 101. So you're risking about 6% for the stock to get back to 120, 130, 140 on a longer term period, right? So always looking for 3-to-1, 4-to-1, upside to downside. If you're trading options, different story. Again, then higher, because options are leverage. So that is my suggestion to you all. I mean, you can't get into a trade or a setup looking at a 1-to-1 ratio. If you're doing 1-to-1s, you're going to lose money nonstop. Okay, so that's the answer of that. Any other questions? No. All right. All right. So it's 1:20. If you don't have any other questions, I will end it. Thank you for the support. By the way, go please. Okay, go to my website, www.sergioavedian.com. Subscribe to the free newsletter. I'm going to start sending them in July. Sergio, if NVIDIA opens low on Monday, I think it will. Okay, yeah, could, possibly. I'm not a buyer of NVIDIA here. I'm a buyer at my support level, which is the 20 EMA, my first touch at 120. 6 points to go. It could go lower. But then, as I said, my risk reward is I'm risking 3 on the downside, 3.5 on the downside with a retest of the high, or 130 at least. 3-to-1 upside. That's a trade. PTP, I hope I answered your question. Please subscribe. Please thumbs up. Share the videos and the live streams with others. I think we're doing good work. We're trying to grow the channel. And that's about it. So much love. Be safe. Stay healthy, please. I will see you guys next Friday. There'll be more news, I'm sure. My little Robinhood account is doing good. I told you, I actually bought options in my little Robinhood account while I was talking to you guys on Chewy. I bought the July 25 calls at 133, 5 of them, all 5. In my other account, I bought 50. On this one, I bought 5. I spent $665. And I think they're like 143, so I'm up $50. I think I sell it. No, I'm kidding. No, I think that stock is going to retest 27, 28. So I'll make money on that. I'm giving it a shot also on the small account. I'm buying the July 15 calls because I can't buy the stock. I don't have enough money in the Robinhood account to buy the stock. So I'm buying BE, Bloom Energy, right here at, I think options are at 30 cents a piece, 30 or 35 cents, meaning $35 for one, meaning 10 will be 350. I think I bought like 20 of those. So I'm splurging. I'm sizing up now. 30-cent options, 40 cents. Where I made my money this week, by the way, I was short the market. I had the triple Q puts, 475 puts. I bought them at 4, sold them at like 580. So that's where the $200 came in. But chugging along. And yeah, so that's it. Much love. Yes, please smack that. What's up, Steve? How you doing, my man? And so we'll see you guys on Tuesday on the other channel, and then we'll see you every Friday here at 10 o'clock. Much love. Take care. Be well. Stay healthy.